markets typically will work. So the gap down, if you're a swing trader, obviously this is like not fun. But if you're like a day trader, then there's definitely some action to be had. So essentially what we're having here, because now we're just stuck in this box, essentially, right? We're just stuck in this box. So you're getting like, green day, red day, green day, green day, red day, green day, red day. That is actually very typical of, number one, rangy type markets. And when you're like trying to digest something or trying to bottom out or level out, it is natural to have like big range days as you're trying to kind of even out and digest news or even bottom out. We talk about this a handful of times, like markets, sometimes you get like a V-shaped bounce in a market where it's like you come crashing down and you just bounce right back to highs. But typically that is not how markets work. Bottoms are typically a process versus an event. Very rarely are they event. So, if you look even in the past, if you're just looking at like even this past year as like a guide, we had like a fairly decent sized dump here in August. And you can see like what happened is, it took months to really digest. But you had inside here, like, see, these are some really big days. So you'd have like huge days, and then you would come like and have huge down days. And see, you were like gapping all over the place. See all these gaps? You were gapping all over the place. So the market was having monster up days and down days, but you weren't coming crashing down and you weren't popping up. It's like you can see, look how big this day is here, right? From 188 to 186. So that's 7 points on a $180 name. You're having pretty big range. And so when you see something like this, what would you normally think? You would think like, wow, like the market's gonna, come crashing down the next day and keep going down. But then you would just get a green day. And then you'd get a big red day. Then you'd get a green day. And, that's how like this market worked like for a while in the past. You can do that where you have big volatility, big range while you're like trying to digest and even out. And so that's going to be, something that it looks like we're kind of getting inside the cards where it's like, think about this. A few days ago, we were up 1,000 points and it was the biggest up day in, right, the Dow in so many years. And then 2 days ago, we were down 1,000 points and we were like, what the fuck is going on? Like, holy crap. And then yesterday, the market ramped back and it was like, hey, all things are gravy. And now, right, we're kind of gapping back down. So overall, we're just like in a big box and you got to trade this box. That's all you can really do. And you have to like ingrain into your heads that in this market, you will get one day up, one day down. So you have to be careful with adding like too much overnight risk, or you have to be careful with adding overnight risk with confirmation, meaning the typical swing trade or multi-day hold play is like after you get a big up day, right, you maybe would add some stocks into the close for the continuation. In this type of market, like essentially you want to be buying on extreme weakness and selling strength because you're inside that box. So just something to kind of be mindful of. This will be essentially the range in the markets that you'll have to be kind of careful of. And then, you want to always watch like previous day's lows, as those will tend to be areas that you got to be just really focused in on. So a couple different things that are happening here. I don't think necessarily like us having like this big down gap or anything is like the end of the world or anything like that. In reality, it's just a range-bound market with a lot of volatility as we're digesting things. And of course, the news flow right now is very heavy into virus stuff. So it only takes like a few things to kind of spook the markets. You may have a monster up day, and then overnight it could be a little bit of this, a little bit of that. You kind of get a little bit of selling coming on, but I don't think it's really the end of the world. I would be a little bit more worried about the markets. If we started to break under this 200 SMA. I think that's when you get a little bit more nervous because the 200 SMA tends to really hold well on the QQQ. You've had 1 test, 2 tests, 3 tests, 4 tests. This is the 5th test of it. So it does have like some significance in the market. If it's not holding, if that area doesn't hold, then I think that's when you want to get really kind of a little bit more defensive. In the meantime, remember, green day, up day, green day, red day, green day, red day. You're not going to have necessarily a rhyme or reason in terms of follow through. So it will vex you. You'll think the market is gravy, and then the market will pull back. And then you will think the market is nasty, and it's dead, and then it'll rip back. That is how always range-bound markets have worked since the beginning of time. What looks good is bad, and what's bad, it looks good. And for those of you guys that like to, smell your own farts, then this is a perfect market for you, right? What's bad to one is amazing to another. We'd be good to go. Now let's take a look at some of these earnings plays. First of all, a lot of the gappers are just from the index ETFs, but you are getting all the virus plays coming back into play. So, I've been bemoaning small caps for a while. We've been trading a couple of these here and there. This APT, they make the masks. This is back in play. AHPI. Man, this thing could be back in play too. If you look at a 30-minute chart, you're kind of starting to round out here. I wouldn't be surprised to see this thing kind of run back into 24, 25. Now, most likely, these stocks have all peaked out permanently, meaning that the top was put in, but just because the top was put in, just like in the markets, maybe the bottom is put in, just because the top's put in doesn't mean you can't get any good rips, right? You could get, some rips into these areas, but most likely the top is in. Like this thing, you don't want to invest in this stuff. This stuff is garbage. They probably don't even have anything to do with anything. But in general, you may get a push into 26, maybe even 30 at some point if the market gets really, really nasty. These virus plays, if you don't like to trade market-based plays when the market gets wild, essentially these virus plays will go up when the market goes down. So if you want to short the market, right, these virus plays will go up. So you can keep Codex, HPI, APT, Lake, NVAX. These are all run together. Okay, so it's a basket of them. Don't oversize on them, because when you oversize on these kind of names, they tend to just drop out of nowhere. And frankly, all the daily charts are really busted on these things, but they are due. Like this has got some support here. These things may bounce a little bit, but they are little illiquid little monsters. So just be careful on them. Not my favorite type of play, but at some point we just have to, plug our nose and dive into the shit. If that's where the play is, we may get some action on these things due to this market kind of being so weak this morning. The Sienna had earnings out today. So this stock, it's already fading off most of its gains. So I'm thinking maybe we take it off the list. At the point when I put it on, it was at like $45. It looked like maybe today was the day. I would still keep it on the list for one particular reason. Sienna sucks to trade. It's a Garbaggio. It's a Garbaggio stock for most of the time. But if you ever notice, like about once every 3 months or so, once every 3 months when it has earnings out, it typically has like a big day. I've noticed this a few times where you see just 3 months ago when it had earnings out, the range was from 38 to 43, but it moved clean that day. And then you know what it does? It has earnings out and it just sits around. It's like it blows its load and skeets it, and then it just sits around. Now, if you look back, to June, same thing. You've got 41 to like 45 range on it. Had a monster day, closed near highs, and then it just kind of skeeted around with no rhyme or reason for quite some time till the next earnings came out. So it's possible that, you may get a bigger day today, a decent-sized day out of this, but I'm a little bit wary of it because, number one, the location of the gap is kind of mid-range. The second part is obviously the market is just fading off. And then the third part is that pre-market is already kind of giving up some of its gains. I mean, you never know, man. It could very well red roll, and end up reversing. So I think we stay away from that one for now. This GRE is interesting. GWRE. This is a software name. They missed on earnings. They must have had earnings out. Earnings call transcripts. They had earnings out probably yesterday afternoon, 4 p.m. This one is already near pre-market lows. You've also got like a nice kind of head and boulders pattern rolling over here that it's breaking under. This one may have a chance. I got two caveats on this one. It looks pretty good on the daily for a potential short, and you're also kind of near pre-market lows, which is nice. The float's only 70 million on it, which is a little bit low for the software sector. So we'll have to be careful to make sure there's no spread on it. But overall, it's got a decent size, decent look to it. How you want to do this type of trade, right? When you have a stock that's gapping down on earnings, you can't just short it into the hole. That's never the case. What you want to do is wait for, we have two patterns we trade at the open. Number one is an ORB, and the second one is a quick pullback buy. So what you're looking for, especially because the gap is going to be pretty big and it's going to have SSR on it, let this thing pull back into its EMAs, and then you want to take it down. So what I mean by pull back to the EMAs and take it down is, if you have like, if you have like a short that you're doing, you would be looking more like, like this would be an ORB. So you gap down and then you take out the opening range. Like that's a nice, easy kind of trade, So it's just very simple. You build out an opening range after the market opens. When you take out that opening range, then, you shred this thing down. So that'd be like, your ideal type of play to get into it. If not, then what you want to do is wait for a quick pullback buy. A quick pullback buy is a little bit different. That's where you get a stock that gaps down on some news, but it doesn't have an opening range breakdown. It starts to push, and you wait till it hits the 9 EMA, and then when you get a red candle to hold, you can take the thing short with a stop at the 9 EMA and let the thing roll, back down towards the lows. So that's a very, very simple setup. Frankly, the quick pullback short, like into the EMAs, is probably the highest reward trade that we do with the lowest risk. The issue on it is, the big hairy butt on the quick pullback setup, which is my favorite. The big hairy Indian butt on the setup is that you have to wait for it because, it takes a while to set up. Where like a lot of times, like an ORB is going to happen the first like 5, 10, 15 minutes. Like, you kind of get your fix on it. But the highest reward, lowest risk day trading setup we have on the short side is definitely the gap down and the short into the EMAs. Man, that setup works like 75, 80% of the time we do it. Like it works. And when it doesn't work, you get out very, very small loss. The problem is always that you got to wait for it, and we're Americans. We don't want to wait for nothing. That's just the way it goes. So when you see this GWRE, that's kind of, that would be the ideal type of play when you want to take something down like that. So just kind of keep that in the back of your mind. You get gap down, hit it into those EMAs, and then you're good to go. MPC, I saw this one. This one's looking like it's kind of getting shredded down. I didn't see the news on it, but Mark was telling me it's like about some asset sale, so that's not really an earnings play per se. Let me see here. But it looks like it's getting shredded. So you got... Oh man, this thing is moving. Yeah, I would add this to the list for now. And the reason I'd add, I hate trading oil stocks. Oil stocks are the worst. At one point, I was an oil man. I dived into the black gold with all the, gusto that I could do. But the black gold is no longer the black gold. At one time, the black gold was where it's at. But the black gold is dead. Now you can see here, you've got yourself a breakdown. 1 test, 2 tests, 3 tests. It's going back a while. The black gold is dead. And this thing is getting punished for, polluting America and we're going to show it what American justice looks like today. Let's watch this thing. You know, if we end up with a little bit of a pop, watch that pull back to the 9 EMA. We may get something. ZM, man, this thing's a bloated pig. Let me tell you something about Zoom, all right? Zoom is hot today for potential short, as long as it holds under the 9 EMA. You know, I used Zoom meeting before, man. It ain't nothing. It's like a Google Hangouts. Right? I use Zoom, man. It's just a Google Hangouts. It's no different than a FaceTime. $32 billion market cap. Today we show it what American justice is all about, baby. And we show what American justice is all about. Let's take this one down today. Wait for 2 setups you got on something like this. It's a tech stock too, so it can move well. You look for ORB or a quick pullback buy right at the open. I think we'd be good to go. Shred. So those are going to be the main plays today. I'm actually thinking we're not getting much of a bounce today. I want to watch. So the market's gapping down big. You can already see this TQQ trending down. That first push, at some point the market always kind of pulls back right at the open. That first one, I want to see how it reacts. Like if it doesn't like really, really squeeze hard, we're getting short this market. Right now I cannot short into the hole. Shorting into the hole means hey, the market's down like 800 points at the open and you just go in and just short it. No. Right? That's very dangerous because the market can squeeze higher at a moment's notice. What I want to see, my plan for the general market index, see how that first push goes. At some point, you'll get a little bit of a squeeze, and then we want to watch for the rollover. If I need it, I'll short this TQQ. I can play SQQ, which is the inverse ETF. Or you can just play TVIX. TVIX a nice trader over here too. You can see TVIX starting to break out these highs right here. So it's definitely going to be in play. It's going to break out over the 200 SMA. Got nice easy range on this. It's actually, frankly, a little bit easier, TVIX, to trade in the pre-market than it is in the post-market, at least lately, last week or so. Good. Anybody got anything they want me to take a look at? That's our list. We're sticking with, let me reiterate, guys. We're sticking with large cap names. Market indexes like TVIX, TQQ, SQQ, the larger names, because the market is getting volatile. We've got a handful of these earnings setups over here that we can use, all right? A handful of earnings setups that we can use that will probably be bucking the market. Beyond that, you have to remember, and we all have to remember, that right now, the nastiness and the gap down today is what just happens in the market when you're in a range. You're going to get a big up day, a big down day, a big up day, a big down day. Ranges are made like that. Don't freak out about it. And the other thing to be mindful, when volatility increases, lower your position sizes. Volatility is up, say, 3x, 4x right now, right? How often do you ever see 1,000-point days in the Dow? Very rare. So if you're trading like the same size as you were before, then you're going to get stopped out a lot and you're going to expose yourself to big risk. What you want to do is cut your position size down a little bit and let the range and the volatility work itself out. Because if you start to get chopped up, when you look, like this TQQ, this is the ETF for the NASDAQ. It pulled back at the open yesterday and it rips, and it goes up 5, 6, 7, 8 points like really, really quickly. If you go on a too small of a time frame, then you'll get stopped out all the time. But also, if you just oversize, you'll get stopped out all the time. So those are just things to just kind of be mindful of as you're working through this. So let's be good. I'll be in the Discord room I'll be in there for a good chunk of the day. As always, you guys are more than welcome to come in and have some fun with us. We got a great group of dudes. And these guys are degenerates, man. They're up at early trading and shredding. Yeah. Patrick, I have noticed that TVIX has been working better in the pre-market. So just something we kind of be mindful of. Cool. Let's go have some fun. Let's go do what we do, which is the do. There is a lot of opportunity in this market, but you got to make sure that you're trading small and you're letting these things roll. And guys, check on the YouTube channel. I think I just posted it yesterday. I did a webinar 2 days ago on how to trade these kind of volatile markets. If you check, there's a replay link for it. And that playbook I talked about in the market, in that is exactly how I'm going to trade today. So you can go in, rewatch that video. It's probably like, it's not a video, it's like a 2-hour webinar. Watch that thing. It's going to give you a clue on how we're going out and attacking this market. All right? Let's go have some fun. Let's do what we do.